Alright, welcome to this week's edition of HNWLifeinsurance.com. Today we're going to be talking about flexible premium universal life, crediting rates, and mortality costs. And the reason we're doing this is to illustrate how changes in interest rates can affect a flexible premium universal life product. So what you'll see is I've inputted a couple of requirements here. We've got a male, age 65, lives in California. We're assuming a preferred non-smoker, and we've got a total face amount of $10 million that we're looking at. And what we want to do is we want to solve for the level annual premium from now until age 100. This is just a starting point. It's certainly not an ending point, but what we're going to take a look at is how crediting rates can affect a universal life insurance policy. So what we're going to do is we're going to start by changing the current crediting rate, and the reason we're going to change the current crediting rate is because we can't illustrate a crediting rate that is higher than what the current crediting rate is today. With this particular product, the current crediting rate is 5%, but we're going to start and change this to 4% because that's going to ultimately affect what our annual premium is going to be. So if we take a look at the quick view, we're going to see an annual premium of $190,000, $190,063. We're going to have $10 million of death benefit, and you'll see here is my net surrender value column. So over a 10-year period, we'll have put in $1.9 million, and we'll have $490,000 in the policy. Year 20, we'll have put in approximately $3.8 million, and we'll have almost $4 million in the policy. So remember this number, 190.63. Now if I go and I change my crediting rate back to the current rate, which is 5%, what we'll see is the premium drops from 190 to 185. So you know, it doesn't seem like much of a difference, but it's $5,000 a year, and over a, let's just call it 35-year period, 35 times 5,000, that's roughly $150,000 savings. So you know, it does have some impact. Where this really has some a lot of impact is, you know, if we bought the policy at 5 and interest rates dropped to 3, or if you bought a policy in the 90s or early 2000s where the policy was illustrated at 8% and now you're getting 5%, that's going to affect what you are going to be able to achieve. So now let's do something a little bit different. Let's take that 185,403 and we're going to fix that as far as our premium is concerned. Then what we're going to do is we're going to change our crediting rate to 4%. Now what you'll see is that policy at the current crediting rate lasted to age 100. By reducing the crediting rate to 4%, the coverage only lasts to age 86. So this is a little bit more impactful than showing a $190,000 premium. What we've effectively done is if we enter into this contract and over the next 20 years we end up getting 4% crediting rate, it's going to reduce the length of time the coverage lasts by approximately 14 years. Now this is significant when you're doing estate planning, and this is something that not a lot of people are aware of. They think they bought this product and that it's going to last their lifetime. Because it is a flexible premium universal life policy, there are certain risks, and they are primarily interest rate risks. Fortunately, right now we're in such a low interest rate environment that it is very likely that we're not going to see a reduction in the length of coverage. We're not going to see a reduction in the crediting rate. So let's go back in and see what this does. So let's say we're at 4% today, and we're going to solve that premium again. It's about $190,000, $190,063. So we've put $190,063 in as our premium, assuming a 4% current interest rate in the policy. Let's see what happens to the policy though if we get 5% over the life of this policy, since that's what the current rate is at. And what we're going to do, so we're telling the crediting rate that we're now at 5%. The premium duration, what we're going to do is we're going to ask it to solve for how long we have to pay this premium. Again, since we assumed we have to pay $190,000 based on a 4% crediting rate in the policy, we shouldn't have to pay $190,000 as long or for as long of a period of time as if we are to earn 5% over the life of the policy. So what you'll see, let me just go back here, we've said solve for the premium duration, and we've increased our crediting rate from 4 to 5. And we go into here, and you'll see we have $190,000 as our premium payment. We have a $10 million policy. But in year 29, or age 94, the last premium payment is made, and it's not even up to 190, it's actually just under 175, and what you'll see is the coverage continues to last for 100 years. So if we solve our premium based on an interest rate that is 1% less than what the policy is currently yielding, and we end up getting 5%, then we only have to make 29 payments instead of 35. So this is a great approach to make sure that you do not outlive your life insurance coverage. Alright, so I've gone ahead and put all of these into an Excel spreadsheet so we could take a look at them real quickly, because obviously I've been jumping around quite a bit. So if you'll recall, under the current interest rate, which is 5%, the premium is $185,403 per year, and that lasts us through age 100 for $10 million of coverage. Now, if we don't get the current interest rate and instead we get 4%, which is 1% less than the current interest rate, then the premium would be $190,000 per year, and the coverage would last to age 100. Under a different scenario, let's say this 185 that we have today at 5% drops to 4% in the future, and we don't put any additional premium payments into the policy, then that coverage is going to lapse at approximately age 86 or in 21 years, definitely falling short of our goal of funding this to age 100 by approximately 14 years. Now, flipping that scenario, starting out with the $190,000 of premium and then assuming that we're going to get 5% is going to require us to make fewer payments over the long run and obviously less of an outlay. So this is a quick review of crediting rates and how they affect universal life policies. Please feel free to give us a call if you have any questions or would like us to review your policy. As always, please forward this to your friends if you think they may be of interest, or leave us a comment. We love to hear from you. Thank you and have a great day.